So the next topic we're going to talk about today is cat bonds. My name is Chris Tedisco. I work for GAM, or an asset management firm in New York City, specializing in global macro hedge funds and specialty fixed income, which including cat bonds, which brings me to introduce Dr. John So. He's the co-founder and managing principal of FERMAT Capital. FERMAT was founded in 2001, currently manage over $2.5 billion in cat bonds, of which 95% or so is institutional. We're definitely seeing continued interest in Canada from institutions with cat bonds, and he also manages a fund for GAM. John has over 20 years fixed income experience trading. It includes 12 years of trading cat bonds. He has a PhD in biophysics from Harvard University and a Bachelor of Science of Physics from MIT. Prior to 2001, he held numerous positions, most notably he worked for Lehman Brothers as senior trader on the insurance products group, and also is managing a portion of the Harvard Endowment for a few years, and then also he started his career at O'Connor and Associates trading exotic derivatives. John also testified in front of the U.S. Congress as an expert on the field, and about a few years ago, Michael Lewis wrote an article for the New York Times about John and the cat bond market. So I will stop talking now, and I will hand it off to John. He's going to discuss what a cat bond is, the history of the cat bond market, characteristics and benefits, and what investors should be looking at when you're looking at cat bonds. So, John?
All right, thanks, Chris. Okay, so I'm here to talk about catastrophe bonds. This is kind of interesting. I've actually been doing this since 1998. And the relationship with GAM started because the CEO just wanted to put his own personal money in. This is back in 2003, 2004. And I remember he told me, because our core model is just that we do giant managed accounts for what we'll characterize as top 20 global national pension funds or sovereign wealth funds. So we're kind of new to this kind of fund market thing back in 2003. So the CEO at GAM passed a hat around to his friends, and they put together, I think, $150 million, and they created a fund. But I remember he said, with a name like catastrophe bonds, it's going to be at least 5 years before we could even market this. So it's only last year that I had a website for the first time, and this is my first talk of this sort here in North America. Actually, it's been a long time coming. And I think it's only because now people are looking for alternatives. This alternative is what I'm here to talk to you about. So what are catastrophe bonds? I'll just put it simply. Earthquakes, hurricanes, we lose money when they occur. Okay? But they're offered in a very simple form. They're at issuance, typical bond is a 3-year floating rate note. It's a quarterly coupon linked to treasuries, U.S. treasuries. And it pays an average spread these days, a fixed spread of 10% over T-bills. Typical rating is double B, but you do have single B bonds. There are currently $15 billion in cat bonds outstanding across 130 different issues, tied to roughly 32 different regional earthquake or hurricane risks around the world. So it's real simple. You can pull up every one of them on Bloomberg, and thanks to our Patriot Act, you can actually look at who are the major institutional holders of each of these bonds, and you'll see a lot of names that you recognize. PIMCO has famously been long an investor in the asset class since 1997, typically holding several hundred million of these bonds at any given time, putting them in typically in every one of their funds except for their 2 money market funds. Characteristics and benefits. Minimal interest rate risk, as already explained, they're typically, they are a floating rate coupon instrument, and the reference rate is T-bills. But they have, so they have very low interest rate risk, but they have a very high coupon. And as I say now, that average coupon spread is 10% over treasuries. Low correlation. The asset class has been around since 1997. So we've gone through the collapse of long-term capital and every other crisis since then, including natural catastrophes. And it's come out looking pretty good. You can punch it up on Bloomberg. A Swiss Re double B index is reported on a weekly basis. and those are real live prices. There's no mark to model here. So very low correlation. The liquidity is actually quite high. So these bonds trade through crises. They also trade through natural catastrophes. Even bonds themselves that are threatened with a loss and eventually take a loss trade continuously in the market. Good example is last year in the great Japan earthquake that we had. There were 15 different bonds for a total of $1.5 billion in risk capital outstanding, all impacted by that event, and they all traded continuously immediately after the event. And even the one bond that took a complete principal loss traded continuously over the next 2.5 weeks from par. The last trade was at 9 points on the dollar, and 2 hours later they pronounced the bond dead. Minimal credit risk. The principal in these bonds is sitting in cash or treasuries. The investment opportunity, it is a specialist asset class, and many large pension funds, sovereign wealth funds actually have pronounced it an asset class. So they put it at the top level of their fund right alongside the general allocations to stocks, bonds, real estate, and they'll actually have a line for catastrophe bonds, believe it or not. So not everybody's that way, but I would estimate out of the top 20 largest national pension funds and sovereign wealth funds in the world, maybe a good third of them have actually gone through that step, which we all know is not an easy one to do. It's a process that can take 5 and even up to 10 years to do, but they've gone through it. So it's a specialist asset class offering genuine structural fundamental diversification. It's not synthetic, it's not hedged. It's just the basic logic is that stock market crashes just don't cause hurricanes or earthquakes to occur. And although, of course, you can have an earthquake or a hurricane that's quite large, these events still aren't anything compared to the moves that you're seeing in a financial market. So, for example, the big one for us that would just melt down the market, cause the market, let's say, a 25% loss, would be a Great Miami Hurricane. That could be a $500 billion economic loss, but in the context of a $15 trillion economy, in the context of an event that's not a credit event, and so less of a contagion problem. Every study shows it's just really a small bump in the road for the broader market. As already discussed, minimal exposure to credit risk. The principal is sitting in cash or treasuries. Low exposure to interest rate risk. If you're afraid of 3-month T-bill interest rate risk, it's not for you. Otherwise, that's looking pretty good. Low exposure to financial market risk, and it's relatively young and inefficient. What we're showing here, the green line, is the Swiss Re BB Cat Bond Index. If you've got an active manager knows what they're doing, then you can actually beat that index. So that's kind of what you get just by passively holding the BB bonds out there. And you can see it's not, so I've had some folks comment to me that looks like a pretty smooth ride. Any of you that knows how to read graphs like this, you could see it's no free lunch. I mean, it's a little bit of a roller coaster in there. You do get punched in the gut every now and then by natural catastrophe. But even in our worst year, which was 2008, in which we had Saturday morning, September 13th, 2008, we had the landfall, the largest observed hurricane in modern history, took out Galveston and a chunk of Houston. Hurricane Ike caused a loss to a bond. Then 2 days later, in the morning, Monday morning, September 15th, we had the flash bankruptcy of Lehman Brothers, which is our largest market maker in the market, and also was a swap counterparty to some key transactions in the markets. We don't use those structures anymore, but they were used back then. And then we had mass one-way selling of hedge funds, who at that time held roughly 1/4 of the market and liquidated every penny on the spot just to raise liquidity. We still had a positive return in 2008. So it's a new asset class, but it went through a severe triple test in which a central player in our market had a flash bankruptcy 2 days after a major hurricane put a dent in our market, and mass one-way selling by hedge funds who really don't hold this asset to a significant degree since their prime brokers don't let them leverage it anymore. We still came out with a positive return. So you can see this kind of return profile that you're dealing with. And this is a very colorful slide. The market has a colorful history. It starts in the early 1990s. We had a hurricane and earthquake in the U.S., and they weren't really huge events. They were the largest by far at that point. What was key about it is that the insurance companies expected the losses to be 10 times smaller than they were. So they had flawed tail risk models back going into those events. But there was a very enterprising woman by the name of Karen Clark who actually started up a company with these catastrophe models that do get it right. They have stunning accuracy, actually. And I think at that time she maybe had like 2 clients in total. And so she faxed out on the morning of one of these events what her estimate of the loss was, over 10 times larger what other people were estimating, and she pretty much hit it on the nose. So now that model and other models like it are used by regulators to regulate the system. And using those models, the system was bankrupt. So it was chaos, and into it stepped Warren Buffett in the late 1990s. He did a single earthquake trade with the state of California, and he made roughly $500 million profit from it. And he had a 99% chance of success, right? So you do a trade with a public entity, and they have to publish the terms. It created a huge kind of gold rush type mentality. Every major broker-dealer in the U.S. and in Europe got involved. Lehman Brothers actually they all wanted to securitize this asset class. Lehman Brothers took an interesting tack. They took 30% of their capital, and they risked it on a proprietary basis in the asset class in an attempt to replicate the Warren Buffett trades. That's where my background comes in. I was the senior trader there in that group. The cat bond market is born, and it grows at 20% per annum until today. The slide's actually indexing to the end of 2010. We're now at $15 billion. We're experiencing record issuances. And these types of attractive risk-reward opportunities still do exist. I would say by some measures they're actually better than they were at the birth of the marketplace. The state of Florida just completed a $750 million catastrophe bond. It's the largest single tranche cat bond issued in history just a few weeks ago. And that was paying T-bills plus 17.75% coupon. And that was against a 2.5% expected loss default rate. It's a single B piece of paper. But that deal was so attractive, they could have actually doubled the size of the deal from there if they wanted to. And I think that they do intend to in the future. So that's kind of the brief, colorful history of the marketplace. Early 1990s, oops, we've got 10 times more tail risk than we expected. And then over the last 2 decades, it's just been trying to catch up on that. And frankly, the market's $15 billion right now, but to actually meet the demand for covering this risk now, it would need to be $150 billion. It needs to be 10 times larger than it is. And the risk is intrinsically doubling every 10 years. We also have increasing regulation that's slamming the market. So same book of business, they're actually requiring insurers to hold even more capital. But at this rate, even at 25% per annum, we won't catch up for another 20 years until the market becomes like a $300 billion market. So that's the current outlook. We're having record issuance and record yields. Summary case, why invest in cat bonds? I never like the word alpha used in this context, but in a broader context it is. It doesn't have a traditional market beta, and it does have an excess return. So I guess under some definitions it's alpha. So you get an attractive risk premium. You're getting paid for the risk and then some. You're getting paid, in many cases, 5 to 20 times the odds. It's uncorrelated. Nothing's perfectly uncorrelated, but the fundamental uncorrelation is the thing that I think that you really want to rest your hat on. Again, stock market crashes don't cause earthquakes and hurricanes to occur spontaneously. Tail independence. We do have a tail risk. It's definitely not a free lunch, right? You could get punched in the gut and be down 10% in a year. You can be down 25% in a year if the big one hits, Miami annihilated. But it's not the same tail risk as in the rest of your portfolio. That's the idea. So you have tail independence. It's a growing market. It is absolutely liquid. My holdings in the funds that I run for GAM, I could liquidate 3 times over within a week and not move the market. Especially on the bid side, the demand for cat bonds is extremely high, especially portfolios of cat bonds. And there's essentially no duration risk, interest rate risk. And yet you're getting paid the type of yields that you're used to seeing on highly leveraged portfolios or portfolios with incredibly long duration. So I think I spoke too fast. But in part, it was actually just to leave time either for you to go to lunch early or, or to allow you to ask some questions.